Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors, and I am joined by DCrowell of Mortgage Network, and we are here to discuss all things where your money matters. So David's actually going to kick us off today with a little bit of a summary of the mass amounts of excitement that we have been seeing for the last week or so in this sort of January doldrums. So where would you like to begin?
I'm going to be very careful. I'm DCrowell from Mortgage Network. I'm going to be careful with reciting the precise numbers because I'm not as good at that as Emily is. But I'm going to give you an overview of something very strange that's happening.
We should have a disclaimer that just says we discuss things in a range. It's a range.
That's right.
It's general. It's very general.
So precision about the numbers is really Emily's responsibility. Kind of a big woolly overview is my responsibility. So here it goes. There's something strange happening. We've had a whole bunch of economic indicators and job and reports, financial reports, economic reports coming through. The biggest of the big companies, Amazon, Alphabet,
which is Google.
Apple, which is Google, they're all doing extremely well and reporting great numbers.
Well, it's a mixed bag, but yeah. Okay, we'll agree that if we're doing the woolly general,
the
that
woolly
yes.
general,
Okay.
They're doing just great. The economy is doing great. The jobs numbers came through strong again. Manufacturing indices are stronger.
So it's time to go buy another house.
Everything's ticking along. This is not the Trump recovery. This is not the Obama recovery. This is 8 years of continuous growth, and that growth for the last maybe 6 months or so appears to be accelerating slightly. We don't know whether it's really accelerating or not, but it appears to be. But it's basically all good news. The response of my market, which is the bond market, to that is that we are getting trampled. Our 30-year interest rates have gone from the 1st of January at 3.99% to today. We will, at some point today, be at 4.5%.
Wow.
So that doesn't sound to a whole lot to you sitting watching this show, but that's a lot. That's a 15% increase in the interest rates over a 30-day period. Simultaneously, all this good news should send the stock market further rocketing into the the upper reaches of who cares, 30,000, 40,000, who cares? But what in fact has happened is that the stock market has gotten trampled for a couple of days. Now I'm going to pass it to Emily, but I just want to point out that there is no precise explanation of why this is all quite so turbulent. There's something hollow in the middle here, and it's really hard to figure out what it is.
Right. So you could take any of these variables and run away with them. But as far as January goes, we had the best January. I think the statistic is it's the best January since March of 2016. So go figure. But across the board, whether it's the Nasdaq, the Dow, the S&P, the Russell, they've all had a fantastic January, even though the last week has been really topsy-turvy. So there's lots of variables to play in here, and each one of them kind of pulls a different lever in a different direction. So it's just a question of which is the strongest pull on the lever, which ones actually pile up to become the strongest directional pull to see where that goes. But in an intra-trading or intraday trading has just been all over the place. We've seen the VIX jump quite a bit, and we saw the same thing last week where we're seeing 300-point moves within a day, 300-plus point moves within a day. That doesn't mean that we're up 300 points or down 300 points. It means that we're moving in that range throughout the day, sometimes even more. Some of that has to do with what you've probably heard called algorithmic trading or program trading, which is basically driven by models in a computer. So sometimes when you see big shifts and big moves in the market at one time throughout the day, and lots of times it happens in the afternoon, sometime 1:30, 2 o'clock in the afternoon, where you'll see some of these shifts happen. A lot of that is program trading. That's just big quant models that are taking effect. So that's one thing. So that certainly drives the market, but it's not necessarily based on fundamentals. It's usually based on some sort of a program, usually technical analysis, maybe some fundamentals, but it's usually looking at broad indexes. Sometimes it's individual stocks too, but usually broad indexes that you'll see those program trades are looking at, and that's what's being factored into their models among lots of other factors. So that's one thing that's moving it throughout the day and causing some of this volatility. That's not necessarily causing the market to go down. It's not necessarily causing the market to go up. It kind of works both ways. It's just whichever direction that model might be working. It could even be a model that's short, that's actually looking to benefit from selling into the market. So that's a factor. Another factor, of course, is interest rates. And so we've been talking about the need and sort of the desire to see a step up little by little in interest rates and what might actually happen with that. And it's happening little by little. So the good with that should sort of propel things forward is that we have simultaneous economic growth. And as we heard over and over again during the Davos analyst conversations, it's simultaneous global economic growth. So we're seeing that across the board, which is good, and it should bode well for sort of an underpinning of the equity markets. However, when we see jumps like David was just talking about, those are considered so-called surprises, even though it's been expected for quite a while. And those surprises are what tend to cause fear that perhaps companies are not going to be able to refinance debt at the same level, that their cost is going to go up. But you have that in tandem with this economic growth, this global economic growth. So really and truly, and that's, we're seeing every day ups, downs, because there's also, and again, there's so many variables, but when we have a jump up in interest rates like we have today, the 10-year jump to 2.83 or something like that.
282 when I arrived at work this morning, and it's probably gone up since this program started.
So what tends to happen with that, when we have the billions of dollars or trillions of dollars that's sitting in cash on the sidelines, whether it be in the US or in Russia or in China or Europe, wherever it might be, that money will end up flocking to that 2.83 yield. That if you look at that relative to stocks, I think the S&P right now yields somewhere in the neighborhood of 1.25 or 1 1/3 or something like that. So if you are somebody who's looking for yield and you have money in stocks and you're getting 1.5% yield, but you can get 2.83% on the U.S. Treasury with no risk or very little risk, then you're perhaps going to move your money there. So that's sort of the fear, is that in part it's going to be because companies are going to have higher cost of capital. On the other hand, there's also going to be an alternative for an investment. What that also does, though, is if that cash is flowing into that 10 years, it should push the yield back down again. Yeah. So we're going to see this constant struggle, most likely for the next 12 months until there's a little bit more visibility on if we're going to have a spike in rates, if we're going to have an inverted yield curve. That should come to pass in the next 12 months. But in the meantime, the fundamentals, as David was saying about, with all the earnings reports that have been coming out, fundamentals by and large have been really good. There's always one-offs, and we won't get into the Apple or Amazon or Alphabet specifically, but by and large, earnings reports have been strong. It's been a really good report on the fourth quarter, and projections looking forward are still pretty strong. There's nobody really guiding. We've had several quarters in the past several years where we'll have guidance down looking into the next quarter. That's not happening right now. The guidance is still pretty strong across the board, even with the cost of oil going up kind of nicely, and with interest rates jumping up a little bit. So it's been an interesting, there's so many factors to figure in. I think the point of that is that none of us have tomorrow's newspaper. None of us have that magic 8 ball anymore that we can actually talk to and see what's happening tomorrow. Even within hour to hour within the market, none of us have that. So the point is just looking at the broad, woolly, general fundamentals are still strong, regardless of whether we're seeing a 2.7 10-year or a 2.8 10-year or a 2.9 10-year. Those trends are still overall good. You look kind of angry at me right now.
No, I'm not angry at all.
Or if I'm stealing thunder in some way.
She's just monopolized the entire first segment. But that's exactly what I wanted her to do, because she had all the numbers at the tip of her
Discussed all
tongue.
this beforehand.
No, that was my plan.
All right.
Because it is a time at which it's necessary to focus on all these numbers and to try to make some kind of sense out of them.
It's also, though, not a time to look at everything and say, let's make wholesale changes, because even though we might see volatility throughout the day, those trends are still expected to be strong. Does that mean it's going to happen, that there won't be a correction? Absolutely not. But the trends are still there. And
in the second half of the show, what we'll do is try and focus on what the impact of all of this is going to be in the local economy here.
sounds good. Stick with us. We'll be right back with more Money Matters.